Good day, everyone, and welcome to this RMA Risk Readiness Briefing Special Coverage Series. I'm Stephen Martin. I lead the Business Solutions Group at the Risk Management Association. The RMA is proud to make this presentation complimentary to members. And if you're not already a member, I urge you to go over and check out the rmahq.org website to see all that RMA has to offer. Today's webinar is the latest installment of our credit trends in commercial lending with data through May 31st. It's a part of our Risk Analysis Service, and today will be presented by Tom Cronin and Jeremy Tolson from AFS. During our presentation, as always, if you have a question for the speaker, you don't have to wait. Please submit it using the Q&A feature at the bottom of your Zoom screen, and we'll address as many of your questions as we can at the end of the presentation. And those of you who have been with us before know that that's a very important segment of this webinar. So I urge you to think about your questions and get them loaded. So at this time, I'd like to turn it over to you, Tom, and thanks for joining us today.
So thanks, Stephen, and welcome to everyone joining us today. And I also wanted to thank last month's attendees that completed the survey at the end of the webcast. I just want to let you know that your comments are extremely helpful. We've used a number of the suggestions from those surveys. And once again, you're going to see some of those suggestions put into play today. They really help us tailor this webcast to what you need and what you're looking for. So as Stephen said, our data source today is the Risk Analysis Service, or RAS as we call it. In RAS, we gather performance data from banks every month, process and verify about $1 trillion in exposure and 875,000 loans, and return that data to each bank member via a workstation. And then with that workstation, member banks can then compare their data and their results to select groups of peers by segments such as collateral, industry, deal size, etc. And we've been doing RAS now since the third quarter of 2003. Hold on. All right. So we're going to examine the C&I portfolio on the next few pages. And by way of definition, C&I loans are business purpose loans made to companies with annual sales north of $1 million. These loans are manually underwritten and also manually risk rated. And just for information, loans secured by owner-occupied properties are here in the C&I portfolio. So our first chart is our trend and performance chart. And on this chart, we track the performance measures in RAS since the third quarter of 2003. The red line is the non-accruals. The dark blue line is 30 to 59 days past due. The yellow line is 60 to 89 days past due. And the green line is loans that are 90 plus days past due. And if you're going left to right, you see the impacts of the recession, especially with the non-accruals in 2009, beginning in 2009. The subsequent recovery, which was interrupted by the energy crisis in 2016. Again, very visual with the non-accrual line. And now the rise due to the COVID restrictions. So let's focus on the results since late 2019, early 2020. And we'll start with the delinquencies. And looking at the blue line, we hit a service level high for short-term delinquencies of 1.33% in April of 2020. And 1 month later, we hit a service high for loans 60 to 89 days past due with a rate of 0.34%. But since that time, while being very erratic, the delinquency rate has moderated substantially, with the 30 to 59 day rate now at 0.37%, almost 100 basis points below the high, and the 60 to 89 day rate now at 0.07%. So delinquencies have come way down since the initiation of the pandemic. So let's switch to non-accruals, the red line. And in the period leading up to the numerous business closures due to COVID, the non-accrual rate had leveled in the 0.70% range after coming out of the oil and gas crisis. But then as restrictions were put in place, the non-accrual level climbed and peaked at 1.03% in November of 2020. Since then, the non-accrual rate has dropped in 5 out of the last 6 months and now sits at 0.91%. So let's take a closer look at the non-accruals. So it appears that the pandemic interruption high for non-accruals was reached in November of 2020 from the previous slide we just saw. So I thought we'd take a look at what's happened since then and concentrating at first on the 2-digit NAICS level. So the blue columns you see here represent the non-accrual levels for each industry as of November 2020. And the red columns are the non-accrual rate for May 2021. And if you go back to November, looking again at the blue lines, there were 5 industries that had non-accrual rates above 2%. Those 5 were starting on the left and going to the right: 21, mining, oil, and gas; 45, retail; 56, admin; 71, arts and entertainment; and 72, accommodation. Pardon me. And in the 6 months since November, all of these saw decreases in their non-accrual levels, with the exception of 71, arts and entertainment. So coming up, we're going to take a deeper look at 71. So NAICS 71, arts, entertainment, and recreation is the official name. And it's obviously a very broad description of the businesses within this sector. But by dropping down to the 4th digit level, we can get a better idea of what's actually doing well and what's not doing well. So here are the 9 4-digit NAICS subsectors for 71, NAICS equals 71. And as we've discovered with many industries and subsectors throughout the last year, the performance is uneven. And by that, I mean, you can't say all of 71 is bad. So if you remember that the overall non-accrual rate is close to 1%, on this chart, you can see 4 subsectors above the market average levels. The first one is the largest, 7131, amusement parks is the worst at 9.11. Going over to the left, to the right, 7139, other amusement is next at 6.14. And in this other amusement category, this is where you get skiing facilities and fitness facilities. And actually, the 7139 is one of the largest subsectors we have. So that's a substantial amount of money. Far below these two, but still above average, if you go back to the left, are 7111 arts performance companies at 2.38. And 7113 promoters of performing arts, sports, and similar events. And all the other subsectors, so the other 5 subsectors, are all below average. Pardon me. So a suggestion from last month's survey was for us to show more of the industry detailed data. So we wanted to stay with looking at the 4th digit NAICS level, but we also wanted to discuss industries that were relevant. And by that, I mean had some outstandings to them. So we calculated the non-accrual rate for all 300 plus, I think there's 320 4-digit NAICS codes, but we limited the next 2 charts to just the largest 100. And all of those 100 are at or near $1 billion in outstanding. So these are all substantial. And on this chart, we're showing the industry subsectors with the highest percent non-accruing as of May 21st. And I don't think there are any surprises here. The issues with oil and gas have been well documented. So 2131 is drilling oil wells, and along with the oil and gas extraction, 2111 are the 2 worst performing subsectors. The next 3 subsectors, starting with other amusement, are all high touch industries. And the only subsector on here that actually puzzled me, if you go over to the right, the 3rd from the right, was 5324 commercial rental. But when I looked further down the NAICS hierarchy, I found that this subsector was comprised, or part of what was comprised of this subsector was office equipment rental. And given so many office closures, this became logical. And at the other end of the spectrum, the other end of the largest 100 four-digit NAICS, are the 10 subsectors with the lowest or best non-accrual levels. And I'll point out here right away that you can see the axis on the left is much different from what we just saw. And many of these subsectors are technology related. The three best, which are on the right, the 5182, 5152, and 5111, are all subsectors of information. And then in the middle at 0.002, 5173 telecom makes it 4 out of the top 6 for information. And now hopefully I won't offend anybody by saying this, but if you look at 4248, beer wine merchants, I just want to let you know I've been doing my part to keep this category in the best performing area. So here we're staying with our examination of non-accruals, but moving on to geography. In RAS C&I, when we indicate geography, we're talking about the location of the borrower. So if Bank of Vermont has a loan to FedEx, that loan is going to be displayed as being from Tennessee. And we're back to the format of our second chart, comparing the non-accrual level from November 2020, the highest level for the pandemic, to our latest data, May 2021. And if you agree that the 0.005 increase for the Eastern Midwest equates basically to no change, every other region had a significant decline in their non-accrual, with the exception of the Middle Atlantic. And to me, this is indicative of the widespread improvement we saw for the industry change chart. And simply put, most businesses throughout the country are doing better. So since the Mid-Atlantic was the only region that had an increase in non-accruals, we wanted to see which states within the Mid-Atlantic had an increase and which states did not, again, comparing November versus May. So in November, Delaware and New Jersey had non-accrual rates just below 2%. Since then, both states have gotten worse. Delaware has gone from 1.92% to 3.32%, and New Jersey has gone from 1.89% to 2.61%. And Virginia also jumped, but from a much lower level, so 0.54 to 1.14. And the biggest increase in Delaware was for NAICS 71, specifically amusement arcades, which we have just talked about earlier. So let's stay with our state level analysis, but expand it beyond the Mid-Atlantic to the entire country. Here we show the 10 worst states ranked by non-accrual level. Louisiana and Oklahoma are the two worst states. And within Louisiana, as you'd expect, the highest level of non-accruals are for oil and gas operations. But we also see high levels, again, within Louisiana for waste management and cruise lines. And most of the non-accruals in Oklahoma are upstream energy related, with a small portion related to specialty trade contractors. And here are the 10 states with the best or lowest non-accrual levels. And 6 are from the middle of the country. Then 2 of the states are from the New England area, and then we have Alaska and Hawaii. And I think what's more telling here is what we don't see, areas that people would tend to say are doing well. And that would be the South, the Mid-Atlantic, and the West Coast. Let's move on now to credit quality, and we'll start with the trend in criticized loans. And by way of background, in RAS, we take a bank's native risk ratings for a borrower and map them to our RMA 10-point scale. On that scale, loans rated 1 through 6 are rated pass. Anything above a 6 is tagged as criticized as follows. A 7 is special mention, 8 is substandard, 9 is doubtful, and 10 is loss. As you can see here, at the height of the recession, the overall percent criticized was above 20%. But at the end of 2018, the percent criticized had dropped to just 5.5%. It drifted up throughout most of 2019, and then we saw substantial increases in early 2020, topping out at 8.59% in September of 2020. We've had slight declines for each of the past 8 months now and have the percent criticized level at 7.41%. And most of that decline has been in the special mention category, as these loans appear to have been resolved very favorably. Here we're looking at the percent criticized for each two-digit NAICS industry sector. And while there are 8 sectors above average, 5 are close to or above 15%. These are 72 accommodation at 20.1%, mining, oil, and gas at just a notch below 19%, 48 transportation at 17.2%, 71 arts at 17.2%, and 45 retail at 14.8%. And we wanted to mention that accommodation hasn't been above 21 mining, oil, and gas since 2014. So it is now the worst industry in terms of outlook. And the hotel subsector within 72 remains in the 30% range, while drinking places are still elevated despite most of them being open above 14%. And another industry within here that is high is caterers. That's close to 30%, which you would expect would do well now that offices are beginning to open. Here we have the percent criticized by geographic region. And the Southwest region continues to have the highest level of criticized loans, but it has improved since May of last year. The Mid-Atlantic has jumped over the past 12 months to just below 8%. And we're also seeing substantial increases for borrowers in the South. So let's drop down a level from region and look at percent criticized by state. And I often compare the ratings versus the performance measures to see if they're in sync. So if you recall, we had this chart for non-accruals, the 10 worst performing states. We had this chart for non-accruals, 10 worst performing states. The 2 worst were Louisiana and Oklahoma. Neither of those are on this chart. And the first 5 on this chart are nowhere to be found on the non-accrual chart, but yet are all 20% above criticized. So there's somewhat of a disconnect when you look at performance and quality at the state level. It's much closer when you look at the industry level. And one last look at credit quality and criticized. Here are the 10 states with the lowest criticized levels. And once again, comparing performance, we find little in common at the state level. Quality and performance do not appear to be related based on the numbers that we have. Now we're going to finish our look at C&I results with 2 charts related to growth. This first chart looks at the loan balances for each bank month versus month. As an example, if May's balance is greater than April's, that bank goes into the green section of each column. If May's balances are less than April, that's a decrease and goes into the red section. And as you can see, it looked like we had emerged from a slow start to 2021 in the last 2 months with positive or more increases for February versus March and March versus April. But for April to May, we're back to where we saw more banks with a reduction in their loan portfolio, as banks are still struggling to grow deposits or grow loans despite the improving economy. And this is our last C&I chart. And yes, it does contain some CRE information. I'm aware of that. So it's a good segue into CRE. But this data comes from our pricing service, But I've included it here because I believe it speaks to how banks are reacting to growth pressure. The chart on the left shows pricing or by the LIBOR equivalent spread for C&I investment grade in the blue and non-investment grade in the red. And the same thing is shown on the right side for CRE loans. And if you look at the LIBOR equivalent spread for non-investment grade, May 21 versus May 20, both C&I and CRE, there really hasn't been much movement in pricing. There's some fluctuation, especially with CRE, but the May 2021 rates are about equal to the May 2020 rates. But it's a different story with the investment grade and for CRE versus C&I. For C&I investment grade, the May 2021 LIBOR equivalent spread is less than what we saw a year ago. For CRE investment grade, the LIBOR equivalent spread for May 2021 is higher than what we saw a year ago, almost by the same amount that C&I is down. I think that's just a coincidence. And the CRE LIBOR equivalent spread is now back above the C&I rate. So both the spread for both C&I and CRE investment grades has been dropping as banks are competing strenuously for better assets. Now we'll move on to the CRE results. And a quick definition before we look at the charts. CRE loans are made where the primary repayment of the loan comes from renting or leasing the property. These are often referred to as investor-owned properties. And this chart shows the trend in our performance statistics, this time for CRE loans. Again, the non-accrual, 30 to 59 days past due in the blue, non-accrual in the red, 60 to 89 days in the yellow, and then 90 plus days in the green. And the results are very similar to what we saw with the C&I loans, with one exception. So short-term delinquencies, 30 to 59 and 60 to 89, have improved substantially since the pandemic high reached in April of last year. And the non-accrual level continues to drop from the pandemic high reached in January of 2021. The only contrary indicator here is loans 90 plus days past due, the green line. These long-term delinquencies have increased in 10 out of the last 12 months and now sit at 0.6% for May 2021 versus 0.19% for May 2020. So almost up 3 times. And we're going to take a look at this a little bit later on. But let's move on to non-accrual. And this chart covers the past year and displays the trend in percent non-accruing for the top 8 property types and also the overall average, the dotted line. Now the red line represents lodging. And over this 12-month period, the non-accrual rate for lodging has gone from 0.13% to now 9.0%. No other property type has a non-accrual rate close to that 9%, and no other property type has had this much movement in their non-accrual rate. Healthcare is up from 0.39 to 1.43, and retail is up 0.39 to 1.19. But at the opposite end, residential has dropped from 0.55 to only 0.13, but lodging by far is the largest issue. So I'm not going to spend a lot of time on this chart, but what we created here is a chart very similar to what we did a few months back for C&I and the impact of oil and gas. When one industry performs much worse than all the others or one property type, it's often beneficial to look at the data without that industry. So on this chart, we've done that. The red line is for all properties, and the blue is all properties minus lodging. And for most of 2020, these lines moved up in tandem. But towards the end of the year, the all minus lodging flattened, that's the blue line, while the all including lodging continued to rise and peaked in January. Both have headed downward since then, but lodging is definitely causing the overall average to stay high. Now, I'd mentioned on the CRE performance slide that the only performance measure that was moving up was 90 plus days past due. And as you can see here, most of that increase is related to lodging. And when you add 90 plus days past due to the non-accrual level to get the non-current level, lodging has a non-current level above 12%. And this is by far and away the worst property type, as the next closest is retail at slightly above 2% non-accrual. So this is our last chart, and it's an alternative look at growth. Here we've used the new loan dimension in RAS. And with that, we're looking only at loans that were originated in the month of May for the top 8 property types. So this is not change in balances. This is loans that were actually added to the books in the month of May. And you can see very clearly by looking over on the right side that over half the new loans was for some type of living or some type of housing, 32% for multifamily and 28% for residential. The next closest property type is office at 12%, and industrial lags at 12, office at 15, industrial at 12. And loans for lodging or healthcare have been very minimal. So that concludes our webcast. And just a quick summary. The overall improvement measures for both C&I and CRE continue to improve. Amusement parks and lodging are still performing considerably worse than the average. And with few exceptions, credit quality also continues to improve. However, commercial loan growth remains weak. And when we look at growth, the increase in the new multifamily property types leads the segment. So Stephen, I'll turn it back to you.
Great, thanks, Tom. Another interesting look as we work our way through this whole situation. So just a reminder, if you've got questions, now is a good time to put them in the Q&A section. We've got a couple that are queued up, and don't want to miss your opportunity to ask a live question on it. There was an earlier question from somebody that had not received the slides earlier, I guess this morning. So if that's the case, you can reach out to me and I can get those into your hands. But otherwise, everybody should have that in their inbox, or maybe look in your other folders, your messaging folders. All right, first question, Tom, comes from Zarek. What is driving the increase in C&I non-accruals in Delaware?
It is amusement arcades.
No kidding.
Yep.
Well, that's certainly understandable. I think this has probably been mostly closed during the bulk of the pandemic. All right, thanks for that. Next question is a CRE question from John. Is CRE credit quality best understood with the criticized pass ratings or with respect to delinquencies?
So John, I'm going to give you my personal opinion. I'm not sure if this is going to be shared by everybody here, but I'll tell you what I think. I tend to look at performance, and I'm not trying to disrespect any of the people that do risk ratings for a living, but I tend to find that risk ratings trail what's actually happening. So I look at performance, either delinquencies or non-accruals, as to what's really happening in the marketplace.
And Tom, I don't think I would argue with you in terms of performance. However, as somebody who does do a bit on the dual risk rating world, I would think that, depending on your system, John, you could be able to see declining trends or some other deterioration when you look period over period. And so if you, in particular, if you're going to be doing quarterly looks with the ratings, you might be able to see it run through the different passes into a criticized status. But otherwise, Tom, I think performance is probably your best and most trustworthy indicator. All right. Next question is from Colin. Oh, same question for Virginia. What's driving the C&I increase?
In Virginia, the increase was for telecom, which was kind of, if you remember, a lot of the charts we show, particularly the one, all the 51s were doing well, but for some reason in Virginia, the telecom industry is having issues.
Gotcha. Thank you. All right, our next question comes from Daniel. Thank you, Daniel. Can the disconnect between non-accrual versus criticized be explained by conservative risk rating adjustments, not necessarily driven by payments?
So Rob is going to have an issue with this one. So again, and not to diminish the risk ratings. I think part of what you find in risk ratings is that they're usually changed after the fact. And I think that's why you see, something happens and then later on the risk rating gets changed. That's my opinion. Stephen, you might have a different opinion there.
That's probably what happens. It's not what I'm, advocating. I think we can do better as an industry. I think we could be on top of it, but I think, Tom, I can't argue with you. All right. Another question. Thank you, Daniel. Are there any specific industries other than hospitality that are showing up in Oregon as under stress?
Daniel, I'd like to take a look at that. If you could send me that question in an email, then I can remember to get back to you. I'll give you an idea of what's there.
Okay. Maybe, Tom, do you mind progressing to the page that has the email addresses on?
Sure.
Perfect.
There we go.
So for Malgorzata and Ryan, if you're looking for the slides, you see Stephen Martin's email address. Just drop me a note. It's not, your email address isn't showing up here on Zoom for me, and I'll get those over to you right away. All right. Well, this is last chance for questions, everybody. Give it a second or two. All right, I'm going to keep an eye on it, but I'm going to wrap it up otherwise. So would like to thank you once again, Tom, and again, Jeremy, because I know you're super involved in getting all this together. Appreciate your insights and thoughts on it. And thanks for everybody who's attended today and has stuck with us over the last many months on this. We look forward to having you in our next session at the end of July. So also, if you were unable to join last week's live demo of our new user interface for the risk analysis service, you can watch that on demand. Tom did a great job walking us through several use cases that showed in a live sense how that new user interface really works. And I encourage you to see it. I think it was only about 30 minutes. There was a lot of great Q&A in there, and you'll get a good sense of how this product has improved. And let's see, looking for any more questions on that? No more questions. So with that, it concludes our webinar for today. Tom had mentioned the value that we get from the survey responses. So if you get a chance at the conclusion of this, please put in your thoughts on how we can make this better. And thank you. Have a great day.
Thank you.